In this video, we're going to look at Levi Strauss, the clothing company, the company that makes those denim jeans. And what I do in my videos is I run my discounted cash flow model to figure out the true value of a company's stock. I look at their financial ratios and then compare them with their competitors. I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $4.9 billion. So that's the value of the company according to the stock market. And they're trading at $12.33, so one share of stock is about $12. Now we need the free cash flow, and the way you value a company is you estimate the future free cash flows and then discount that number back to today's value, which is exactly what I'm doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Now I'm pulling the net income on the income statement, and this is the profit and loss for the business. And next we need the revenue, which are the sales for each year. The numbers look pretty steady and fairly consistent, so we should get a good value for the company. Let's get their interest expense. That's the interest they pay on their debt. That's $66 million. Let's see their debt. We'll go to the balance sheet. We'll go to the liability section. Current debt of $7 million. That's debt due within 12 months. Long-term debt of $1 billion. That's debt due after 12 months. They pay 6.5% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. The income before tax is $478 million. The income tax is $82 million. So their tax rate is 17%. That means the cost of debt is 5.4%. The beta is not in Yahoo, and I think I found it on another website at 1.3. So we're going to use that to figure out the cost of equity. Now we need to get the current assets. We'll go back to the balance sheet. And we need the current assets to calculate the current ratio later. And that's $2.9 billion. Now we'll pull their current liabilities. These are debts and payables that are due within 12 months. That's $1.2 billion. And their equity of $1.6 billion. That's assets minus liabilities. We also need their EBIT, earnings before interest and taxes. And that's $566 million. Let's look at their capital structure. The cost of debt is 5.4% and they have 39% debt. The cost of equity is 12.3% and they have 61% equity. So the WACC is 9.6%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $7.3 billion. We divide that by 397 million shares, and we get an intrinsic stock price of $18.47. They're trading at $12.33, so they're trading at a 33% discount, so it's a buy according to the model. Let's see what Simply Wall Street has. They're $17.61, so they're a little lower, but they're also saying it's a buy. Let's look at the historical stock price to see where the stock has been trading. So it looks like the stock was trading above $20 at one point, but it seems like it's been coming down every year or so, and it's at a fairly low point. So the stock could be a good value if you think the future of the company is going to be strong. I'm not sure how sales are going to be with coronavirus, not as many people shopping, although people are shopping online. Let's look at their financial ratios to get more information. They have a good PE of 12.4. That's price of stock, $12.33 over earnings per share, 99 cents. To get earnings per share, it's net income over shares outstanding. So this implies investors are willing to pay $12 for $1 of earnings. Usually a PE under 15 is considered a good value. Price of sales of 0.9, that's great. That's price of stock over sales per share. Under 1 is considered a really good value. The way you calculate sales per share is revenue over shares outstanding. Next, we need the price to book ratio, which is 3.1. That's also a good ratio. That's price of stock over book value per share. To get book value, it's equity over shares outstanding. I like to see below 3.5. So all their ratios seem good so far. Current ratio of 2.5, which is fine. That means they can easily cover their current liabilities. Their current assets are 2.8 billion and their current liabilities are 1.2 billion. ROE at 25%, which is good. I like to see above 20%. That's net income over equity. So they're providing their equity holders with a 25% return. Interest coverage ratio of 8.6. That's EBIT 567 over interest expense 66. So they can easily cover their interest payments. And a good way to look at ratios is to compare them to similar companies. Capri Holdings is in the same industry as Levi's. And although Levi's had good PE, price to sales and price to book ratios, Capri is even better. But they have more debt, and when you take on more debt, you could make your price to earnings and price to sales ratio look better. Both of them are doing fine in current ratio. Levi's has a much better ROE, and they're twice as big as Capri. So let me know what you think of the video. Leave a comment. Thanks for watching.